This is your 11th program in the series on accounting. It is about notes and interest. When every family produced its own goods and services, no trade was involved. When production became specialized, trade occurred and money was needed. When an economy becomes complex and highly productive, credit is used in place of money. We say charge it, or put it on my account, or use my credit card, to refer to a transaction which does not involve immediate exchange of money, but the obligation to pay the money in the future. Such credit accounts usually are intended to carry charges for only a few weeks, but additional arrangements may be made to extend payments for longer periods. Why do we need credit? Right. Trade receivables are the accounts that result from sales of merchandise, while a promissory note reduces to writing the terms agreed on by a buyer and seller. This makes one firm's note receivable, another firm's note payable. A promissory note is a signed promise to pay a sum of money to someone, either on demand or at a specific date. What could you call a general agreement to pay for credit charges at monthly intervals? Right. Some notes call for payment in a specified number of days after they are made. Other notes may call for installment payments beginning on a certain date. The payments are usually monthly. The characteristics of a promissory note are that it is first, unconditional; second, it's a signed promise; third, to pay a sum of money; fourth, to some specific person; fifth, on demand or on a given future date. Notes usually provide for the payment of interest. The use of money is worth money, which we call interest. If your company had extra cash, it could invest in a U.S. government note, perhaps for 60 days at 6%. This would return a 1% interest payment. In 60 days, for example, the use of $10,000 would pay $100 in interest. What are the characteristics of notes? Yes. If your company needed extra cash, for example, because its customers bought on credit, your company might have to borrow and pay interest for the use of the money to a bank or other lender. If your customers don't pay cash or pay accounts promptly, sales prices would likely be slightly higher to pay for the use of the needed money. Companies sometimes charge interest on unpaid accounts receivable to make up for the foregone opportunities to invest the cash it would otherwise have had, or the interest it must pay. Is this fair? Yes. In the same way, notes usually include a provision for interest as a charge for the use of money. You probably already know the formula for the calculation of interest. It is the principal times the interest rate times the time period. For example, the interest on $1,000 at a rate of 6% for 6 months is equal to $30. To avoid confusion, we will usually say interest rate for the annual rate of interest and interest paid or earned for the amount of money paid or earned. Time is usually stated as a fraction of a year. Remember, for simplicity, the business world assumes that the year has 360 days. If your company borrowed some money for 90 days at an interest rate of 8%, how much interest would it pay? Right. Here's an easy way to find interest on some notes. For example, when the annual interest rate is 6% and the time period is 60 days, since 60 days is 1/6 of a year, the annual interest of 6% yields 1% of the principal in 60 days. Don't forget, interest rates are nearly always given in yearly rates. So as a shortcut, 6% interest for 60 days can be calculated by moving the decimal point in the principal amount 2 places to the left. Interest at 12% for 1/12 of a year or 30 days would also be 1%. So would 9% at 40 days or 8% at 45 days. For example, find the interest cost on $5,000 at 6% for 60 days. Moving the decimal point 2 places to the left gives $50. What would you pay, including interest and principal, at maturity? Right. The shortcut interest technique can be used for other interest rates or time periods. For example, interest for 30 days is 1/2 of 60 days interest, and at 6% it would yield 1/2 of 1%. If an 8% note earns 1% interest in 45 days, what would a $1,000 8% note earn in 90 days? Yes. Here's a 90-day note which was originally made on April 15th. When will it mature and need to be paid? Don't forget, although April and June have 30 days, May has 31 days. Yes. This note resulted from a $1,000 sale by the ABC Company to the Smith Company. Look at the entries on the books of each party to the note. The entry on the left would be made to ABC's books, the one on the right on Smith's. Notice that ABC's receivable is Smith's payable. On July 14th, Smith must pay $1,010, the maturity value. In addition to entries in cash and notes receivable, ABC will credit interest revenue, and Smith will debit interest expense when the note is paid. Here the XYZ Company pays a $500 note plus $5 interest to the PDQ Company. To make entries to record this event for both firms, notice the XYZ's interest expense is PDQ's interest revenue. A firm may accept a note receivable in settlement of an overdue account. Two reasons for this are that a note can provide for interest, and it is better evidence of the obligation. This entry reflects the acceptance of a note receivable in settlement of a delinquent account. If the debtor is unable to pay the note on its due date, this should be recognized in the accounting records. The obligation may be returned to the accounts receivable account, and the dishonored note receivable written off with a credit. If the debtor agreed to pay interest on the note, the $10 interest earned is recorded with a debit to accounts receivable and a credit to interest revenue. The two entries may even be combined into a single entry. What entry would be made to notes receivable? Right. To record the dishonor of a $600 note receivable and $9 accrued interest, your entry should look like this. A promissory note with certain characteristics is a negotiable instrument. This means that the rights to a negotiable instrument may be transferred to another person by a simple endorsement on the back of the instrument. This negotiable note matures in 60 days from April 15th. When the note was accepted on April 15th, this entry was made. The maturity date or due date is June 14th, which is 60 days from April 15th, the date when the note was made. The maturity value of the note is $606, which is the total of principal and interest that must be paid on the due date. If every month were exactly 30 days long, a 60 or 90-day note issued on, say, April 7th would be due on June 7th or July 7th. But February is 28 or 29 days long, and January, March, May, July, August, October, and December are 31 days long. So a 90-day note issued April 7th would be due July 6th because of an intervening 31-day month. When was a 90-day note issued January 10th, 1976, a leap year, due? Yes. Bankers often use small electronic calculators or more often reference books to find the due date and interest cost for notes issued on a given date at a certain interest rate. This saves manual arithmetic and probably reduces errors. On April 30th, the company had an unanticipated need for cash. It wanted to convert the note to cash without waiting for the maturity date. So it transferred the note by endorsement to a bank and got money in return. This is referred to as discounting a note to a bank. Why do you suppose it is called discounting? Right. The bank must wait 45 days until the note matures. This is the discount period. In other words, the bank is purchasing a note on April 30th that will mature in 45 days and pay $606. Naturally, the bank expects to earn something for making what amounts to a 45-day loan. In this case, the endorsement by the company carried with it a liability to pay the note in the event that the maker defaults. This obligation is sometimes referred to as a contingent liability. What does this mean? Right. The bank usually subtracts its fee for purchasing a note from the maturity value, the value of principal and interest. The amount subtracted is known as the bank discount. The remainder, known as the proceeds, is paid to the firm that sells the note to the bank. Let's say the bank charges a discount rate of 6%. The maturity value times the discount rate times the discount period yields a discount of $4.55. The company will receive the proceeds of $601.45, which is the maturity value of the note, less the discount charged by the bank. Remember, principal times interest rate times the term of the note yields the amount of interest. When the interest is added to principal, we get the maturity value. When a bank subtracts its interest from a discounted note, what is the name for the money paid to the company? Yes. Maturity value times the discount rate times the discount period calculates the amount of the discount. And the maturity value less the amount of discount yields the proceeds from discounting a note. Notice the similarity between the interest and discount calculations. We could say that discount is merely interest paid in advance. Remember, interest is added to principal to get maturity value. Discount is subtracted from maturity value to arrive at proceeds. When a note is made to a company which is later discounted to a bank, what happens? Right. The note that was discounted by the company will yield proceeds of $601.45 calculated as shown here. So, in effect, the bank is charging the company $4.55 for a 45-day loan of $601.45. The bank will collect $606 at maturity. The proceeds to the company are debited to its cash account. The proceeds exceed the principal amount of the note. Interest revenue is credited to balance the entry. If the proceeds are less than the principal amount, interest expenses must be debited to balance the entry. This means that when proceeds are greater than principal, there is interest revenue. When proceeds are less than principal, interest expense is recorded. When a note is discounted, what happens? Right. Don't don't forget, discounting a note receivable is the process of selling a note receivable to a third party. The face value plus 6% interest for 60 days equals $1,010 maturity value of this note. This note is discounted at 6% on June 30th, which is 30 days before it is due. The maturity value less the bank discount of 6% for 30 days equals $1,004.95. The journal entry to record the discounting of the note should record interest revenue, or $4.95. The note discounted by the company matures on June 30th, and hopefully the maker of the note will pay the bank on the maturity date. But if the maker doesn't pay, the bank will require the company to pay, since it is the endorser of the note. When the company pays the maturity value of the note to the bank, it opens an account receivable from the original maker to record the dishonoring of the note. How much would be entered into the account receivable? Right. A credit account usually has an agreed payment time or period. When a customer wishes to extend the period for payment, he may issue a promissory note for this purpose. Occasionally, a company may lend cash to someone, perhaps an officer or employee, and accept a promissory note as evidence of the loan. How would this be shown in the journal? Right. A customer may issue a note upon the purchase of something, say equipment, in which case the transaction is never recorded into accounts payable unless the note is dishonored. The customer debits or increases his asset account, equipment. What does the customer credit? Right. Typical transactions which involve notes receivable are notes which are received in A, extending a customer's credit account, B, for merchandise or other assets sold, or C, for a cash loan to an employee or other person, and for notes which are collected, dishonored, discounted, or renewed. Typical transactions which involve notes payable are issue of note for merchandise or other asset purchased, note issued to extend an account payable, or a note issued for a cash loan, and a payment or extension of a note payable when it matures. A properly drawn promissory note is a negotiable instrument. It should be a written and signed promise to pay made by one person to another specific person a specific sum of money on a certain date or on demand. It should bear interest. What can be done with a negotiable instrument? Right. Credit is an important and useful concept which must be carefully used. A promissory note is a formal evidence of debt which must be honored and never be treated casually, for it is enforceable by law. As in other accounting matters, the recording, classifying, and summarizing of credit accounts must be performed carefully and accurately.